Hey friends, Ernie Veritimus here from the Trader of Futures channel, and I have a few things I'd like to talk to you about today, particularly about Hurricane Harvey and its effect on the people of Texas, on oil, gold, and the Fed on the futures of, or the future prospects of the overall market. But first, I'd like to pay our respects to those who suffered through Harvey. I mean, for most of us, Harvey was really just a non-event. For instance, if you live on the East or the West Coast, you're probably not going to see any weather that will disrupt your lives. I mean, gas prices might be up a bit depending on where you live, but that's about it. And it's hard to feel connected to a storm except for the images that you see on the internet or on TV. But make no mistake that Harvey was a monumental local disaster, and it has uprooted the lives of thousands or even millions of people for weeks or even months to come. And if you live anywhere near or in the path of Hurricane Harvey, I hope you, your family, and neighbors came out of this experience unscathed. And just from the bottom of my heart, my thoughts and prayers are with you. Now, as you may know, oil is big business in the Gulf region, and particularly along the Texas coast where Harvey made landfall, and in the Houston area in particular. And I don't want to minimize what happened to the people with the flooding and the wind damage because it was horrific. But from a market perspective, traders may be perplexed at the inverted response to oil and the muted response to the distillates like gasoline and heating oil, especially considering the disruption to service with the shutdowns of refineries. Now, oil today at one point was down well over 3%. But you may ask, I mean, how could that be, especially in the face of a plummeting dollar? I mean, the location of Harvey and its unique characteristics made this basically the perfect storm in terms of oil disruption. Yet, how could prices go down so sharply when supply is disrupted? It seems to contradict everything that we know about supply and demand. Now, there's actually a few reasons why oil is down. Part of it is because with refineries offline, there's going to be less demand for oil, at least temporarily. The other big reason is that that Saudi Arabia, along with Russia, they've been hemming and hawing over how they're going to extend the cuts to production, which they most likely will instill, but that's not enough for Wall Street, as the street would rather see an increase to those cuts to achieve something they call rebalancing, which basically means they want more profits. So the expectation is that the supply of oil will continue to build despite the fact that we've had 8 straight weeks of inventory reductions. Now there are various reasons for this, but the important point is this. You can expect oil prices to continue to fall right through to the end of this year. And believe me, that is an opportunity for people who are trading oil. Now, how low will it go is the real question, and when will it return is another great question that, I don't know, no one really knows. But, I think the best guess among analysts is a turnaround somewhere in late 2018 and 2020. Now, this should look like a stimulus to the economy. The combination of low energy costs and low interest rates could usher in another great market move, the likes that you could only possibly imagine. I mean, the markets have gone up enough already, but believe me, with this combination, it could really skyrocket. But the fly in the ointment is rate hikes in December. Now, the current odds for a rate hike of about 25 basis points has dropped to just 32%. And that could change if this economy doesn't show any signs of heating up soon. I mean, this week we have some big economic reports that will give us a read on the economy, like the GDP on Wednesday. We're looking for a 2.8% growth or better. And the employment situation on Friday, we're looking to add 200,000 jobs. But the bond market is hedging its bets by continuing to tick down yields. That's profound. I mean, it's effectively flattening the yield curve just a little bit more each day. And as you well know, and as I know, and what Greg says, you got to watch the bond market for clues on where the market's heading. I mean, I personally believe that the smartest traders in the world are in the bond market. So I wholeheartedly agree with Greg's sentiment on that. Now, Did you know that virtually every recession since the Federal Reserve was instituted has been preceded by the Fed hiking rates to stave off what they deem an overheated economy? I mean, where's the overheated economy now? I'd really like to know. I mean, riddle me this. Why is the bond market priced like the market is spiraling down and the Fed is hedging their bets with each meeting and policy statement? Yet the markets keep making new highs. There's something that just, doesn't compute there. And this is all contrasted by pretty poor economic reports recently, particularly on the housing market. And I know Greg had mentioned this in one of his latest reports, which is really starting to show some profound weakness. And all during this time, gold just recently broke through that 1,300 barrier. And today was up 0.62%, extending its gains. And perhaps it's going to probably find some support at that 1,300 level, giving it a base from which to rise even higher. Now, silver is up too, nearly almost a full percentage point. It looks poised for a big breakout. Now, I saw the Maestro did a technical analysis report, and I think his report kind of confirms this. So, does this sound like a vibrant economy to you? I mean, yields dropping, a string of poor economic reports, anemic job growth. I mean, let's face it, adding 200,000 jobs a month is a good start, but it's not strong by historical standards, and precious metals are starting to break out. I mean, I personally think that this is a recipe for the Fed to light up this economy and start what some people would call burning hot, which basically means back off, Janet Yellen. I mean, your days are numbered, and you dissed the president by basically calling his anti-regulatory programs foolish. I mean, you're a lame duck. Leave the economy to your soon-to-become successor, whoever that might be. I mean, I'm really beside myself that the Fed thinks that they actually have the temerity and the knowledge to know where the economy is going. I mean, everything seems like a guessing game to them, and they prove it virtually every policy statement. They're a master of saying the right words for the consumption of the market, but that's about it. So, anyways, I have this hat that I picked up a little while ago. If you're familiar with Ayn Rand and Atlas Shrugged, you could probably appreciate this. If you look closely, you'll see that it says Atlas Shrugged, now nonfiction. If you're familiar with that, you'll get that reference. Anyways, that's really all I have for today. I really appreciate you watching me and all the kind words that you said in my last video. And if you have some ideas for topics that you'd like me to bring up, I'm pretty connected to the market. I trade futures professionally. I'm an institutional trader, and I'm constantly looking at the market. I mean, this is kind of my life, and I really appreciate Greg giving me this platform and this opportunity to reach out to you guys and to help you any way I can. So again, thank you very much, and hopefully we'll see you next video.